One stock just cracked today's top 5 for June 30th. Caterpillar just crashed the Russell Top 50 Club, and Wall Street is whispering about an AI infrastructure supercycle that could supercharge industrial equipment demand for the next decade. Right now, the stock is up 3% on solid volume, a respectable move that caught investors' attention. But here's the critical tension. The verdict is watch with up direction, but conviction is LOW. The Russell boost is real. The AI tailwind is real. So why aren't the experts excited? A major divergence in the options market is screaming fear despite the price action looking genuinely strong. In the next few minutes, we're going to break down exactly what retail is missing and whether CAT deserves your capital right now. CAT is trading at $1064.90. That's within 0.8% of its 52-week high, meaning the stock has already made its big move this year and is testing its absolute ceiling right now. Volume is 1.13 times average. That's stronger than normal but not explosive, which tells us there is genuine buyer interest, but we're not seeing panic buying or euphoric FOMO. The 50-day moving average is at $905.99 and the 200-day is at $689.72. This is a pristine uptrend structure, each short-term average well above the long-term one, which confirms the higher highs pattern is real and not a dead cat bounce. The stock is near resistance at $1073.46, with support well-defined at $854.73, giving traders 19.8% downside cushion before the setup breaks. RSI is at 65.36. That's neutral zone, not overbought, meaning the stock hasn't been bought so aggressively that a pullback is statistical odds yet, which gives it runway to push higher without immediate profit-taking pressure. The moving averages are perfectly aligned, 50-day above 200-day in a steep uptrend. But here's the caution flag. We're just 0.8% below the 52-week high, which means you're buying near the ceiling, not near a discount. A close above $1073.46 targets $1100, then $1224.63 for the bulls. For risk management, support at $854.73 is your abort line. That's where the uptrend officially breaks if we fall there. RSI in neutral territory suggests momentum can persist, but price alone doesn't guarantee direction when catalysts fade. The Russell Top 50 edition is real fuel for the next 2-3 weeks as index funds mechanically rebalance and add CAT to their holdings. That's the near-term momentum driver. The AI infrastructure tailwind is a multi-year story. More data centers, more power infrastructure, more heavy equipment to build them all, and CAT is the only industrial play capturing that supercycle directly. But here's where conviction breaks. Industrial guidance hasn't been updated to reflect this AI tailwind. Management commentary on order books, margins, and AI-related capex is missing. Without those confirmations, the Russell boost looks like a 3-week pop, not a 3-year trade. Earnings are unscheduled in the current data, so there's no imminent event to confirm the thesis. The catalysts exist, but they're pricing in hopes, not evidence yet. Put-to-call ratio is 1.697. That means for every dollar of capital bet on CAT falling, only 0.59 cents are betting it rises, which is heady pessimism buried in the options pits despite the stock ripping higher. This is a classic divergence. Price says up, options say down. That split usually resolves one way or the other dramatically. Implied volatility at 0.5565 gives us the price of protection. If Roman 4 is near the 14th percentile of history, options are cheap for hedging. If near the 86th percentile, they're expensive and cap your upside. The reward risk on any entry from here is atrocious. You're risking $190 to make just $8.56 on the first target, a 0.04 ratio. That means for every dollar you risk, you're only paid 4 cents. That math doesn't work unless you're targeting $1,100 or higher. Watch with up direction and LOW conviction means the setup exists, the catalysts are visible, but you don't have permission to chase the current price. The entry zone is $938.28 to $966.43. That's where you'd initiate if you believed in the thesis. And your hard stop is $874.39. The 3% move we saw today doesn't qualify as confirmed breakout. It's early-stage momentum that could easily stall at resistance. If you want to play CAT, wait for either a 5-10% pullback into the entry zone on lower volume, or a breakaway close above $1,100 on volume. Either scenario gives you the confirmation retail is missing right now. Do not chase the Russell pop. If you're already holding CAT, This is a hold and let it run. Don't add until you get pullback confirmation. Russell Top 50 is a tailwind, not a thesis. AI infrastructure is a fact, not a surprise that CAT just learned about. CAT is a quality industrial business, but you're buying it near its 52-week ceiling, not near a discount, and the options market is pricing in downside risk that retail hasn't noticed yet. The conviction is LOW because the story is compelling but the fundamentals haven't confirmed it. Do yourself a favor. Don't chase the pop. Set up your entry zone, define your stop, and wait for confirmation. Either the pullback comes and you get a better entry, or the breakout happens and you'll have proof the thesis is real. Until then, watch the stock, watch the catalysts, watch the options flow, but keep your cash dry. That's the disciplined play.